It's a situation that doesn't seem to make any sense because on the one hand, default rates on mortgages across the country keep rising. And while the housing market is stabilizing, millions of Americans still can't afford to stay in their homes.
On the other hand, though, mortgage bonds are in the midst of a spectacular rally. Go figure. Joining us now to solve this riddle and discuss the risks of investing in this market, Brian Lancaster, head of mortgage strategies at RBS Securities in Stamford, Connecticut. Brian, glad you could join us. Good morning to you. Let's talk about this apparent disconnect. On the one hand, as we say, it's not like the situation is really improving. If anything, it's stabilizing in the real estate market. How is it that people feel so much better about the mortgage market?
Well, I think it's really a contrast to how they felt last year, at the beginning of last year. Last March, I think there was a palpable sense of panic in the markets. People were concerned that, banks might go under because of residential securities and they might be forced selling of it. There was no leverage in the market, so prices got to ridiculously cheap levels, in my opinion. There was no sense that there was a bottom in the housing market. So you're talking about a rally and quite a huge, robust one in these securities from very low levels.
Okay, but so prices were at a ridiculously low level, as you say, but right now they've bounced back so far. It is raising some questions in people's minds as to whether or not this market has become overvalued. What would you say?
I would say, we've probably seen in some of the securities, for example, subprime, increases as much as 70%, which sounds very dramatic. But when you look at, again, where the prices were, they were still very, very low. I would say that at this point, some of the securities seem to be what I would regard as fair value. Others, such as option arms, believe it or not, actually probably still offer significant value. When we take into our account our scenarios of where we think housing is going over the next year, take into account, perhaps another 6 million foreclosures, unemployment remaining high, you can still obtain yields on these securities of anywhere from 14 and 16% on a 4- and 5-year security, which still seems quite attractive.
Brian, talk about how the yield curve, which is at its widest on record at 238 basis points, affects this market. What does it mean for the market going ahead?
I think it's, obviously this is engineered by the Fed, and this is where I will sometimes part ways with a lot of the Fed watchers. I think that it's critical that short-term rates remain low, since so many of these mortgage securities, which are already experiencing extraordinarily high default rates, the assumptions we use, for example, in option arms is 85% default rates. It's critical that Fed funds and short-term rates remain low so that these borrowers don't experience significant payment shock. And in fact, in a lot of cases, some of these mortgages are resetting to lower rates than the borrowers had, which is a good thing. Fed starts raising rates in the next 6 months because of inflation concerns. That could really shock some of these borrowers.
Brian, I don't want to sound overly skeptical, but how honestly can anybody talk with any degree of confidence about what's going to happen in the mortgage market, what kinds of defaults we may see? We know there's a huge overhang of unsold inventory out there. We know there are houses that haven't even shown up in that inventory. We've got 10% unemployment. How low a yield can you assure people of when you look out into the future?
Well, we try to be as conservative as possible. There's obviously risk, as you point out. We could have, unemployment could go back up again. There could be some other shocks to the systems that we don't see. But when we do try to stress these bonds, as I said, we're using extraordinarily high default and severity rates. We'll say 85% of all the bonds in the securities default. 60%, they're experiencing 60% losses. In fact, probably some of the biggest risks in these types of securities is, in many ways, is not so much the markets, but it's Congress. You don't know what they're going to do in terms of loan modifications, reductions in interest rates, and that's that's a harder thing to.
All right, Brian, thank you very much. That's Brian Lancaster talking to us about the risks and potentially opportunities in the mortgage bond market. He's with RBS Securities.